Hello everyone and welcome to my presentation on Derrimon Trading Company, their prospectus for the additional public offer. Um, I am the armchair investor and this is my presentation. But before we proceed, I would like to disclose that this should not be construed as financial advice and the purpose of this video is for educational purposes, all right? So, how did I get here? A few days ago, one of my friends asked, what are my thoughts? What do I think about Derrimon's APO? And off the top of my head, I could have taken the easy route and just said that it's a good company. They have made these acquisitions and you should buy it and let's leave it there. Then I decided not to actually say anything off the top of my head. Take a look at the prospectus and tell him my opinion. And this has led me to here. So let's go. All right. So these are the topics that will be covered in this discussion. The company, then versus now, then being the date the date was listed on the junior market. No, meaning in December 2020, the stock price, the IPO value, their peak value, and where they are now. What is an APO? The shares being offered and the basis of allotment. Key dates, key information, the company's business, use of their proceeds, pre-IPO financial for every review before they were listed in 2013. The last 5 years of their financials being reviewed, and the last 5 years meaning their last five annual report, right? And we'll close off with who the lead broker is and the selling agents. So let's get started, and I really hope that you find this interesting and that you would have learned something. All right. So let's start off then versus now. Um, and I find it fitting that Owen James should be the person that we start off with to discuss the genesis or the beginnings of Derrimon Trading Company on the junior market on the day when they had their listing ceremony. So let's go.
Good evening. This is the Owen James Report. 15-year-old distribution company Derrimon Trading today became the 20th company to list its ordinary shares on the Jamaica Stock Exchange's junior market. The company began trading at $2.05 under the symbol DTL, and at the close of today's trading, its price improved by 14.6% to $2.35. As a prelude to the listing, Derrimon Trading, a company founded by Derek and Monique Cottrell, had a successful initial public offering which yielded over $150 million for its 254 new shareholders. General Manager of the Jamaica Stock Exchange, Marilyn Street Forrest, in commending the new junior market entrant, noted that efficient distribution of commodities was essential to Jamaica's development.
And we are therefore pleased that Derrimon has indicated that a portion of its proceeds from the company's IPO will be used to enhance its wholesale and retail business software platform. Combined with the company's intention of retiring debt, I believe this should result in a positive for investors, the companies, and consumers.
All right. So there you go. That was in 2013 when they at their listing ceremony when Marling Street Forest spoke. And there are a couple of things I wanted to make note of. That the company at the time of their IPO wanted to retire existing debt, enhance their software platform for the supermarket, and I'm not sure if she also mentioned expansion. Now let's fast forward to 7 years later in 2020, and let's see what they're up to now.
So how does an entity move from having a shipping load of sugar into this multi-subsidiary entity that is touching distribution, manufacturing in Jamaica and the region? where we get a chance to sit with the principals of Derrimon Trading to find out how they are feeding families and fueling growth. Come on, let's go.
All right, ladies and gentlemen, thank you for joining us. And today we're very pleased to have with us the chairman and CEO of Derrimon Trading, Derek Cotterell. I got that right?
That's correct.
And we have Mr. Ian Kelly, the group CFO of Derrimon Trading.
Thank you.
All right, gentlemen, thank you very much. So we just start out with Derrimon, the origins. You have to tell us, Derek, how from one container shipping some sugar in 98, we come to this, you know, and we're here in this big, beautiful warehouse, and we have a company with a top line of 11, 12 billion dollars. How you did it?
Well, first of all, let's give God thanks to the Lord.
Amen.
It has not been easy, far from. And when we started out, we didn't think that it would have been anywhere near where it is. I know that we're here, we recognize it can be a lot bigger. And that's the reason why we're doing a lot of the stuff that we're doing now. But we started out in 1998. I had knowledge of this food business. I've been working at Grace Canby for 14 years. We really got into the business in a more serious way in 2002 when we were appointed distributors for Nestle for 4 parishes on this side of the island. You know, we started off in this acquisition thing with Sampars. Since then, we go from 1 Sampars to 7 and another supermarket called Select Grocers 8. Then we acquired majority shareholdings in Caribbean Flavors and Fragrances in 2014. And we also bought Woodcats in 2018. So that's a short version of the story. It has been a lot of ups and downs, but mostly ups. We have enjoyed it. Tremendous sacrifice. You'll see Ian and myself as the face of the company, but there's a lot of, we have about 700 people who work behind the scenes who don't get to show their face on TV very often. But they are really the heart and soul of the business. We have cultivated a very good team, a very good culture, and we have a company that is now ready, poised to go to the next level, and we see its tremendous growth potential.
All right. So that sums up a lot. So let's move forward, all right? So we're gonna now talk about the stock price from the IPO, the peak value, and no. So what I have here is a couple of excerpt from an article which I copied from the Jamaica Gleaner. So to your left, you'll see an article on 2019. I'm sorry, 2013, November 29, Derrimon's IPO priced at $2.05. So let's take a read, right? It says Derrimon Trading Company Limited will offer 73 million of its ordinary shares on the market next week, each priced at $2.05. The $150 million that the company aims to raise from the offer will be used to expand its Sampar's cash and carry business, retire a portion of the company's debt, and finance working capital. The company is said to be looking to establish other wholesale and retail outlets across the island. No, so you'll see that at the company IPO at $2.05 back in 2013. The other article to my right, or to your right also, was on August 22, 2018, and it says Derrimon stock was approved. And it reads Derrimon Trading Company's shareholders approved a 10-for-1 stock split of the company's issued and authorized share capital on Wednesday. The stock split had the Derrimon stock has tripled in value over the past year. It traded Friday at $21. Chairman and CEO Derek Cotterell said the at the company's annual general meeting in New Kingston that the split was expected to improve liquidity of the Derrimon Trading Limited stock. Within the past year, Derrimon Trading Limited has traded as low as $6 and as high as $30. Investor demand for the stock is fueled by Derrimon's growth through acquisition and expansion. The company's newest purchase was pallet maker Woodcats International after this month, and that was in 2018. All right. So I want you to remember the investor demand for the stock is fueled by Derrimon's growth through acquisition and expansion, right? So the company IPO'd at $2.05. In 2018, it went as high as $30, went back down to $21, and the stock split was done when it was at $21. So here we are now in December 24, 2020. So this is a candlestick chart that I got from the Jamaica Stock Exchange. This was yesterday. Uh, the company's stock traded as low as $2.21 and as high as $2.39 on Christmas Eve throughout the day. So that's where it is. So pretty much since the stock split, the company's stock hasn't moved much and has stayed in the $2 to $3 range. Oh. So what is an APO, right? It's short for additional public offering, but it is also a secondary offering, meaning that before a company can do an APO, its shares must have already been offered to the public through an IPO, right? Which is called an initial public offering. And the SPO, the secondary offering, I'm sorry, would have been the company listing more shares to the public for a second time. But let's read this definition that I got from Investopedia, right? A secondary offering is the sale of new or closely held shares by a company that has already made an initial public offering. There are two types of secondary offerings. A non-dilutive secondary offering is a sale of securities in which one of the major stockholders in a company sell all or a large portion of their holdings. The proceeds from that sale are paid to the stockholders that sell their shares. Meanwhile, a dilutive secondary offering, which is Derrimon is doing, involves creating new shares and offering them to the public for sale. Secondary offerings are sometimes referred to as follow-on offerings or follow-on public offers. And here are some key takeaways. The website lists that a secondary or follow-on offering is when a company issues new shares, but after it's already completed its IPO, right? And that an APO is usually done to raise capital, to finance debt, or making growth acquisition are some of the reasons that companies will do this. No, the, the APO which Derrimon is doing is a dilutive offering, which means that the company will have a lower earnings per share and the number of shares in circulation increases, right? What that also means is that you will get a smaller, because your shares are being diluted. When the company decides to distribute dividends, you'll be getting a smaller portion of the pie because your percentage of company that you own as a small investor or one of the other large investor, top 10 shareholder, it will be reduced so you get a smaller portion of the pie, right? Moving on, shares being offered on the basis of allotment for the APO. So the shares are being issued by Derrimon Trading Company, which means that it's not being offered by, one of the major shareholders, right? No, not major shareholders, but one of the other shareholders. And it is for 1.498 billion shares, new shares, and roughly 1 billion is being reserved, are reserved shares, right? And that is about 67 to 68% of the new shares being offered of the $1.4 billion. I must mention that a breakdown of this, you'll see that existing shareholders or Derrimon team members reserve shares. There's a pool of 484 million shares at $2.20. Key investor reserve shares, 378 million at $2.40. Lead brokers clients reserve shares, 151 million, and the lead broker is Barita. So if you have an account with Barita, you have an investor account, you will have shares reserved for you in a pool of 151 at $2.40. So what you'll also see here is that there is a pool reserve for the general public, which is 484 million ordinary shares at $2.40. Right? So the general public are those who wouldn't have any shares in the company, right? And you would have also not have shares, not have an account with Barita. I'm sorry. The There is also an option to upsize for an additional 301 million new shares, and the shares will be reserved on first come, first serve, right? Also, I didn't have that information right here right now, but this offer is to raise approximately, I think it is approximately about $3.5 billion the company intends to raise, somewhere about. And if it's upsized, it will be about 4.2 billion Jamaican dollars. So what are they going to be doing with this money, right? That you, the shareholders, you, the public, will be giving them. And when you become shareholders, what are they going to be doing with that money? But before that, let's take a look at some key dates. So I've intentionally underlined these tidbits because it's really important. It's actually a hint. So it says existing shareholders, the registered holders of the existing ordinary shares of the company as at the opening date. When is the opening date? January 6, 2021, right? And the closing date is January 26, 2021. And it is subject to early closing if it's oversubscribed. But let's take a look back, right? So it says the you can be an existing shareholder if you own shares in the company as at the opening date, and the opening date is January 6th, right? That means you would get to have your shares from the pool, where it's $2.20 per share. So what that means is that if you should actually own at least one unit of share for the Derrimon Trading Company between now and in January, about 2 to 3 days or 2 to 4 days from the 6th, you should be an existing shareholder. And the reason why I said that is because it's not on the day when you actually successfully the order has been completed for the shares, if you should buy it on the open market, that you become an existing shareholder. But 2 business days after your trade is completed or your request to buy some shares is completed, that's when you become an existing shareholder. Because transaction on the Jamaica Stock Exchange is T plus 2, meaning that on the transaction date, it takes 2 days to be settled. I'm not sure if that has been changed, but it could be. All right. So, and also, if you realize, if we should go back at the date, the last December 24th, you realize that someone bought the shares at $2.21. They were able to get some shares at $2.21. That's pretty close to what being offered to existing shareholders. So what this means is that you can actually, it is possible for you to go on the open market and buy the shares at a price that is below what's being offered to the general public, right? And also lead brokers, clients, and key investors. Now, some key information. So while going through the prospectus, I came across this, which I wanted to discuss, and I also saw an article in the media about what had happened with Derrimon Trading Company. They're a junior market company, and there are some rules for companies to be eligible and to maintain their eligibility. And one of them is that the capital, right? Initial capital of that company must be between 50,000 to 500 million, right? And let's see what we've uncovered in the media, right? So the article was that Derrimon sets junior market precedent. Distribution company Derrimon Trading Limited, which operates the Sampars and select supermarkets among other business, remain listed on the junior market on the Jamaica Stock Exchange despite its spending 3.5 billion capital raise. So, which will catapult it 7 times beyond the limit of that specific market. So what that means is that the money that Derrimon is trying to raise through the IPO is not being done by through debt, which they would have done quite often, but they're using equity, right? Meaning they're offering they're offering new shares to in exchange for money, right? And that is being done through equity, and what that also means that the company's shareholders' capital will actually be over the $500 million limit. And based on the junior market rules, that would automatically mean that company must migrate to the main market. But let's discuss the article further. Junior companies are not allowed to hold share capital valued above 500 million. Derrimon will be the exception. Right now, its share capital is valued at 140 million, but its total equity is nearly 1.6 billion. Share capital is generally seen as funds to initially seed the business, which, when added to retained earnings and reserves, grows the total capital over time. So, Derrimon Trading Limited successfully argued to the JSE that by moving to the main market, it would have disadvantaged minority shareholders of CFF, which stands for Caribbean Flavors and Fragrances, which is a company which is owned 60% approximately, or a little bit above, of the shares in that company, and that company is also listed on the junior market, right? And if Derrimon was to migrate to the main market or the big league, right, then that company, Caribbean Flavors and Fragrances, would have to also move, and it would lose some of the benefits of being listed on the junior market, which includes not paying full income tax over a period of time. And it mentioned that that particular rule was Rule 501, Section 3. And to be honest, when I looked at the rule, any lawyer that's worth their grain of salt or any village lawyer could actually argue this rule, right? So this is one of the rules that they're referring to, right? One of the minimum requirements is that that we had said earlier is that companies voting share capital are right is not less than 50 million and not more than 500 million. But here's the part that is also in contention. 501, Section 3 says, is not an associate company of any company listed on the main exchange or on the main trading platform of any other stock exchange. So, just to summarize, Carbon Flavors and Fragrances would have, that rule would have been triggered, that eligibility would have been breached if when the APO was issued and their company's voting share capital would have exceeded 500 million. Derrimon would have migrated to the main market, and CFF would have lost that. But what you see here is that Section B says is not an associate of any company listed on the main exchange or on the main trading platform of any other stock exchange. And as an armchair investor and not a financial analyst or a licensed financial advisor, um, Caribbean Flavors and Fragrances is not an associate company, but is actually a subsidiary, right? And when it comes to rules, right, being written for when it comes to rules, that the rules has to be stated explicitly. What you say is really important than what you don't say. So the company didn't company the rules of the junior market explicitly state it's not an associate company of a company listed on the main exchange, right? I'm not sure if this is being construed as associate in the terms where less than 50% of the companies, it would be Caribbean Flavors and Fragrances, is owned by Derrimon, or if that threshold is breached, or you know, if it meant associate in terms of, you know, there is a relationship between the company in terms of the. Let me just leave that alone. But it wasn't anything tough. There's no it requires no legal gymnastics. I'm pretty sure that this was something very simple, and any lawyer, as I said earlier, that's worth their grain of salt, should be able to argue something. Even a 10th, 11th grader on a debate team should be able to actually argue this. Now, use of the proceeds, which I mentioned earlier. As at the date of this prospectus, the board of Derrimon owns more than 60% of the issued share capital of the company, meaning that the board of directors own 60% of that company, right? If fully subscribed, that percentage will decrease because more shares are being offered, so they'll own less of the pie, right? That, however, is not a signal of lack of confidence. In fact, based on the use of the proceeds, which is what they will tend to do with the money, which is to fund growth and acquisition and repay debt, it is likely to increase the economic value of Derrimon shares, which means that even though they'll own less of the company, the value will be significantly more if they had not got the money to be used as proceeds, right? And so it's like owning 90% of 10 million versus 10% of a billion. Which one would you prefer? Uh, I'm sure you would actually go ahead and say you would like to own 10% of a billion more than 90% of 10 million, right? The proceeds will be used to repay repayment of indebtedness. Derriman has grown through the use of debt. Yes, it has, based on the financials over the years. A significant amount of the proceeds will be used to reduce existing indebtedness and therefore reorganizing the company's capital structure so that a higher percentage of the company's cash flows will translate into benefits for shareholders. All right. So when the company reduces the level of debt it must pay, it means that some of the money that it would have been using from its revenues will trickle down to their net profits, which would is good for everyone, right? Moving on, it also says that if this invitation is fully subscribed, the gross proceeds will be approximately 3.5 billion. 205 million will be used as transaction costs, which is the entire cost for the APO. The net proceed from the invitation is therefore expected to be 3.29 billion. If the option to upsize is fully exercised, the gross proceeds will further increase. The maximum by which the gross proceeds may increase by way of exercise of the option to upsize is 7.23 million. So just to discuss this even further, we're gonna skip to the timetable which summarizes the use of the proceeds, right? Oh, before we do that, the company is actually planning to use a portion of the proceeds to acquire two companies in America, which as part of a strategic planning, right? So let's go to the timetable. Of that 3.5 billion, they'll be using 1.2 to reduce indebtedness, which is the most of it. Potential acquisition of business in the United States, and note the word potential, 1.1 billion. Expansion of retail location in Clarendon, 500 million. Working capital, 20 to 84 million. Working capital is what the company uses to run the operation of the business on a daily basis, right? The transaction costs, the entire cost of the APO would be 205 million, and expansion of their product lines because the company owns a list of products which it doesn't manufacture. I'm not sure if it doesn't manufacture. What I think it is, in my opinion, is products which is manufactured with its brand, which is the Elect brand. They'll be expanding that product line, which should allow them to compete and tap into other markets which they have no presence for their products. That's about $200 million, and that summarizes everything. The company's business. So, the company, Derrimon Trading Company, has been part of Jamaica's story for over 2 decades, powering mills, markets, manufacturing, and making millions in profits. Right? The company has grown to become Nestle's #1 Jamaican sub-distributor and the top national distributor for rice. Now, um, let's also take a look. I've highlighted these in red, which is what we'll be discussing from everything here. It says distribution of Nestle products in Jamaica, importation of wholesale distribution of rice, margarine and detergents, distribution of cold food items, and distribution of SM Jaleel products in Jamaica. SM Jaleel is a company in Trinidad which manufactures Bigger, Chubby, and a few other products. Cool Kids, Turbo, yeah. So that is their distribution segment for Derrimon Trading. Now, another part of the company's business is Caribbean flavors and fragrances, which was discussed earlier. This company is also listed on the junior market. They own approximately 62% of that company. Caribbean flavors and fragrances, they actually make flavors that companies would use in their products, such as Pepsi, and Nephew, Trading Citrus with Cinco, and fragrances, which is used in household detergents, cleaning, and sanitation, right? There's also the Sampars chain of supermarkets where the company owns a chain of them in Kingston, and I think that's a very strategic move that they did by acquiring a supermarket because as a distribution company, you'll be your clients would be wholesales. They'll be one of your clients, right? Supermarkets. And if you can actually own a chain of supermarkets, that means that your products would be listed in those, would be available to get easy shelf space in those supermarkets. And you don't have to compete much or they have preferential treatment when it comes to other distributors. So they're actually, trying to control more of their supply chain, right? Then you have Select Grocers, which German owns 60% off, which is a boutique supermarket, upscale, located in Manny Park Plaza in St. Andrew. That is good for them, and also an opportunity for their products to be on the shelves there, and also to collect revenues from those supermarkets. All right. Woodcats International was one of their recent acquisitions that was done in I think 2018. When this happened, I read the news, I wasn't sure what the company did, but eventually everything was disclosed. They make wooden pallets, which is what are these? Which is pretty important for containers, ports, and so wooden pallets carried in manufacturing and distribution industries as the sole means of packaging and shipping and storing large volumes of goods. It's a subsidiary of Derrimon Trading Company because it's a wholly owned subsidiary. They own it right out by 100%. They also sell byproduct of foods such as distributable plastic pallets. No, the pre-IPO 5-year financial review. I thought this was important And I got this from the 2013 annual report. And what you'll notice is that this is the company's income statement, a few line items from it, a few line items from the balance sheet, and some ratios, right? You'll realize that in 2009, this company was bringing approximately $1.48 billion in revenues, and just a small portion of that was being trickled down in profits, only 4.6 million in profits, right? Distribution and, and retail business is the margins are the cost of sales and is pretty high. So the margins are slim in a lot of cases, right? But what you'll notice is that over the course of 5 years, from 2009 to 2013, this company was able to grow its profit from 4.6 million to 14, almost $50 million. That is almost that is more than, I think, not almost, that's more than a 1,000% increase, right? Unless my math is bad, but yeah, about 1,000% increase in profit. And also you realize its revenue growing from 1.481 billion to 5.2 billion. That's pretty good actually, right? And on its balance sheet, you'll realize that as the company grows, so does its debt. No, I'm sorry, not its debt, but its assets, which are pretty important. A company's asset is what you use to generate revenues and for it to make profit. Without assets, companies don't really get to make money, right? And at the bottom, you'll see some really important ratios, right? From 2009 to 2013, the company's gross profit margin increased from 6% to 10.6. A gross profit margin is basically the cost of company's cost of sales, or what it costs them to acquire the products, right? After that's the difference between the cost of acquiring the products and what they've collected from the sale of the product. The gross profit margins, the more, all right, so it is ideal for a company to increase their gross profit margin, which means that it is likely that with increased gross profit margin, the company will become more profitable, right? That's not always the case, but it is ideal, and it's quite often with increased gross profit margins, the company will have more profit, more trickle down to the bottom line. You'll also see EBITDA, earnings before interest, taxes, depreciation, and amortization. That means the company's operating profit, right? It's basically the company's revenue minus um, the cost of operating the business, right? Which includes selling and distribution, general administrative expenses, stuff like that, which is good. You'll also see where profit before taxation is also the margin is also gets better, and the company's current ratio um, stays at 1, which means that it's able to cover its current expenses or its obligations that's due within 12 months, which is good. But one thing in particular, though, you realize the company's debt to equity ratio, which was very leveraged, very high in 2009, right? That the company was using a lot of debt to finance its operation, right? And but over the course of 5 years, that actually went down quite significantly, where it's actually below 1, and that's great. If you actually take a look over here, I use a compounded annual growth rate calculator to show you the annual growth compounded growth rate for this company over the last 5 years. Not last 5 years, but from 2009 to 2013. This one at the top is for their revenue. So Revenue has been growing over 5 years from 2009 to 2013 at 28.81%, right? But its profit is really impressive over the period of um, 5 years. But I think I made a mistake here. It shouldn't have been 5 years. It should have been 4 years. One, two, three, four. So that means its revenue growing even much higher, and so does its growth rate, right? The company's net profit has been growing over 60% compounded annually since 2009 to 2013, and you'll notice that 2013 is when the company was listed in the junior market, and that's pretty impressive. The company is on the right track. The last 5 year financial review, right? The last 5 year would have been the last five annual reports. The 2020 annual report is not out as yet, so I've decided to only use 2019 to 2015. And what you'll notice to your left is that this is what the company, this is the last 5 years of revenue. No, I'm sorry, keep on saying the last 5 years. This is from 2015 to 2019, 5 year revenue for the company, right? You will realize that between 2015 to 2017, company's revenue growth was slowing, right? And between 2018 and 19, the revenue grew quite significantly, right? And that's really good. Now, if we actually take a look to your right, right, you'll see that the company's revenue has been growing at an, hold on, wow. Oh, this is the 10-year review. Yes, the 10-year review. So over the last 10 years, between 2009 and 2019, the company's revenue has been growing at an annual rate of 23.91%, right? And its profits have been growing at a compounded annual growth rate of 51.78%. And that's really impressive, right? That's really impressive. And I did some calculation in Microsoft Excel just to illustrate the rate of growth of the company by using the annual growth rate for both their revenue and their profit, and you realize that as the timeline extends, the company revenue starts to grow much faster, and so does its profit, right? And in 2019, at the end of the year, the company made $302 million in profit from a revenue of 12.6 billion. And yes, retail and distribution does, the cost of sale is really high. You'll realize that a company made 12 million, not made, collected 12 million in revenue, or made $12 million in revenue, but cost of sales took out 10 billion dollars of it, or leaving them with 2.2 billion to cover other expenses and to leave profits, right? No, I want you to take a look at this. This chart I got from the prospectus for the APO, and it reinforces a lot of what was being said, that the company has been financing its growth through debt, right? So you'll realize the blue column, I'm sorry, the blue bar and bar graph represents assets, purple for shareholders' equity, total shareholders' equity that is, and total liabilities. What you'll realize is that the growth in assets and their liabilities in the chart is pretty much proportional, or it seems to me to be proportional when as the company's assets grow, so does its liability grow on almost same rate, pretty much, right? But its shareholders' equity hasn't grown much, and but As it was said earlier, it is intentional. It's part of their strategy for growth and expansion to use debt, which is a good thing because which is a good thing as long as it is properly planned and what is being financed, what is being the asset that you're buying using debt will work out to generate the type of returns that will be able to generate a profit and cover any expense that is there. And let's move on. So this is also from their APO. The return on assets, it's pretty much, it's generally somewhere in the above 5%, but not much, except for 2017 and 18, where, you know, it went to almost 10% and 6.85%. The return on asset is basically the cost of the total company's total assets divided by, or the company's net profit divided by the company's total assets, right? Or what are the returns the company is getting on the assets that it has owns. You'll also see that the company's gross profit margin is actually increasing over this 5-year period, which is good. Uh, as I discussed earlier, or was said earlier, when the company is increasing its gross margin, it means it is extracting more money from the revenue that it collects, which means that it has more money to trickle down to the bottom line, right? Or more money to cover its finances in terms of finance costs, whichever financial obligation it has, or loan that is, cover staff costs or any sort of SG&A costs, right? You'll also see that the EBITDA margin is also increasing and also its net profit. Now, the company's strategic initiatives, right? Uh, the company will be improving its logistics management and enhancing its warehouse capabilities, growing supply chain, implementing a technology platform, right? Which is optimizing retail and distribution management, which is good. I think CPJ was trying to have worked on a particular platform. Which would be their warehouse management platform to optimize their operations and the management of what they do. Expanding the retail and distribution channels to introduce a modern full-service one-stop shopping experience and development of, of a wider direct product offering focused primarily on consumables and modernizing its pallet businesses. So this company is trying to refine, trying to work on its areas of opportunities throughout the not throughout the company, but areas of opportunities. It is different. It's company that it owns are different divisions in its business. They're trying to work on those areas of opportunity, which is good, and that can only be a good thing for shareholders, right? Let's talk about potential acquisition. So the company is trying to acquire two companies in the United States of America for potential acquisition, that is for 1.1 billion Jamaican dollars, right? And these are some of the projections which they have placed in a prospectus, are which are the ideal numbers for them, right? With these, if it is that they should acquire these two companies, or if it's successful, it would bring more revenues to the company, grow its revenues much fast, and also its net profits. Which is pretty impressive because should those acquisitions come through, and if the company is even able to actually get these numbers in terms of revenues to be consolidated with the group's existing revenues, this would actually affect the stock price on the stock market because I did a back of the envelope calculation. If it is that the company should actually gain 485 million dollars in revenues from these acquisitions along with their existing revenues, the stock price should be somewhere around should be able to go up towards for as high as close to $4. But the market works. The market work. The market can be funny at times. So I don't want to. That's my prediction, my personal prediction, and market can be funny at times. So that time frame can go ahead and actually pass, and the share price wouldn't actually be there. But regardless of, in spite of, if the company is able to extract that amount of revenue and profits and have it added to its existing revenue and profits, that would be really good for um, shareholder value and the company itself. You said over the next 5 years, their average revenue growth is going to be 21.70%, which is not bad. It's not bad. It's in line with what they've been doing so far. Well, so I actually took this one in particular. So there are risks, as there are risks associated to the business being discussed in the APO. And I took this one out in particular, which is specifically talks about its use of leverage, right? So the company is using debt to finance its growth, expansion, right? Which is good. You know, Derrimon want go foreign, but it's mentioned here that the group has used borrowings as a principal means of financing its growth, and at December 2019, approximately 41% of the group's assets. When I say group, it means Derrimon Trading Company, Sampars, Select Grocers, Woodcats, and Carbon Flavors and Fragrances. 41% of its assets was financed using $2.3 billion in debt, and but also means that the company's debt to equity ratio. Let's not go into there, but that means that the company has become, very leveraged. The ideal is to actually have a debt to equity ratio of one, but based on what I'm seeing on their financials, they should be able to manage to cover the costs of their obligations, right? But the using the proceeds of the IPO to actually pay down some of this debt, especially the 1.2 billion dollars, which he would use to pay down some of his debt, is really good because um I think the company's debt is somewhere around almost 3 billion in total, which includes current and non-current debt liabilities, that is. And at the bottom it says part of the proceeds from this additional public offer will be used to fully liquidate indebtedness, which will further reduce the Derriman's group leverage position, which is good. Which is good, right? And we are here. We're going to talk about lead broker and selling agents. Barita Investments Limited is the lead broker, which means they're the ones who are crunching the numbers, spearheading all of this, doing all this paperwork, and taking care of the IPO. APM, sorry. The selling agents, no, are those who are able to actually, you can go directly to them and they'll be able to handle taking care of this for you. You have Scotia Jamaica Investment Limited, JMB, JN Fund Managers, Proven Wealth, and Sagicor Investments. Even though I'm not, you would have to speak with your broker if they're not listed here, to see if they'll actually be able to accept your application for shares from the APO, right? And if they'll be able to forward it to one of these selling agents or the lead broker. And we are at the end of the discussion, and I really hope you find this very helpful. All right, and see you next time.